This is Marty Gross. Thanks for tuning in and taking the time out of your busy day for some great education. Many of you on this call see me as an expert in creating conservative, reliable income strategies that work to provide you the income that you'll need during your retirement years. I very much appreciate the trust and the relationship that we have built. As you know, I believe in constantly trying to better my services to the pre-retirees and those already retired that I serve. What I have found is that a lot of my clients have important questions that they want answers to, but they just aren't sure who to trust or where to begin. Because of that, I wanted to make sure that you know that in addition to being an expert in putting your plans together, I have a team of experts in other fields that I work with to accomplish a common goal. That is, helping you to attain the peace of mind with all aspects of life, health, and retirement income. What I have found is that most of my clients near or in that retirement period of their life tend to worry about three basic things. Number one, outliving their nest egg and enjoying their golden years. Two, protecting themselves from financially crippling illnesses and diseases. And three, and leaving money to their loved ones if that's important to them. Today, in an effort to serve you and be educational, I am bringing in one of my team members, Morgan Marks. Morgan is an incredibly valuable member of my team who I rely on to help me put together your rock-solid plans and to take care of those three things I just mentioned. She helped me bring you the peace of mind that we're striving for, and we want you to retire happy. Morgan is graciously taking time out of her day today to discuss the tools we use for protection and income. If you have questions, please write them down as we go on. Our team likes to tackle each area of concern individually, as we don't believe in a one-size-fits-all plan. Additionally, if you find yourself thinking, I bet so-and-so would appreciate this kind of education, please let me know. I've found that there are so many people out there searching for answers that it certainly makes sense to discuss the options with a professional that can make a world of difference. And the best part is that there's no charge. This is free. So sit back, relax, take good notes, and give me a call. Morgan, I'd like you to start our program by telling everybody a little bit about yourself and what you do before you get started.
Thank you very much for that introduction. My name is Morgan Marks, and I'd like to welcome you to one of our educational installments on life insurance and Life Insurance Awareness Month. There's two things you need to know about me. First, I work in a fiduciary capacity, which means that I'm bound by the standards established of the Investment Act of 1940, exhibiting a duty of loyalty and care free from conflict of interest. Part of what I do requires the highest degree of due diligence, and secondly, as a certified financial planning professional, I hold myself to and abide by the CFP Board's standards of professional conduct. I personally feel that education is tremendously important, and equally important is for you to build a team of advisors that can help you accomplish your goals with the highest degree of care, education, and execution. So today, I'm bringing in two of my team members to talk about one of the most critical but sadly overlooked part of a total protective financial plan. The one thing I will encourage you to do is to use this information to review your situation with a professional. Having an adequate plan in place prior to an emergency is paramount. And this part of your plan is so unique and so important that you need to plan early and review it often. Michael and Eric are going to give us some education, but it's up to you to take that education and review it. Someone obviously cared enough to make you aware of what life insurance can do for you, but the rest is up to you to use that information to do what makes sense for your family. So with that, I would like to welcome Michael Schellinger and Eric Estrada.
Hey Morgan, thanks for that introduction. Today we're going to go through one of the oldest tools of your total financial plan, and that's life insurance. Now let me start by saying sometimes conversations about life insurance aren't so fun, and maybe we don't like to think about what could happen to us, so we do nothing. But if you care about your loved ones, you know you need to be prudent and provide them with protection. I have yet to hear anyone ever say, man, I wish we didn't have that life insurance when a loved one has passed away. So our goal today is just to do a little education. If we all know that life insurance is something that is prudent and a great protector of a family's financial independence, you owe it to yourself to work with a team of professionals that believe in education so you can make decisions that just make sense for you and your family. My goal here today is just to give you a little history education and give you a little insight as to types of life insurance. Then I'm going to bring Eric Estrada on the line. He's going to tell you about the things that life insurance can do for you, especially when we consider the new form of life insurance that can take care of you while you're alive. First off, life insurance has been around since the Roman times, around 100 BC. In fact, nearly 1,800 years later, Lloyd's of London, which I'm sure you've heard of from the standpoint of insuring a baseball player's arm or a singer's voice, started out as a local coffee spot for sailors. Life insurance companies use what we call the law of large numbers and professional risk management to modestly build up assets under management over a long period of time. They're conservative, seeking to use actuarial math and science to set them up for the long haul. And although every company is different, they're institutional investors, and they can use these conservative investments inside their general account. This all comes together to create companies in the U.S. that employ 2.6 million people. To give you an idea, at the time of the 2010 census, Chicago had just over 2.6 million people. The amount of assets backing these companies is staggering because they have, in one form or fashion, been around for so long and built up assets over time. The largest companies are approaching $1 trillion in assets. Just to give you an idea how big that is, if you could spend $10,000 every day, it would take you almost 300,000 years to burn through $1 trillion in assets. Life insurance started out with the goal of using the law of large numbers to instantly create an estate in a time of need. So let's go through the tools that were used before we move into some of the newer things. Going from order of least complex to most complex, you basically have 5 different types of life insurance. Most people are familiar with term insurance. Term is a temporary form of insurance. Think of it as renting insurance. It only provides you with protection when you're in your quote-unquote rental period. When your lease is up, the new rental rate reflects your new age and can easily double or even triple your premiums. Next up is whole life. Think of whole life as just more of a contract. If you pay the premiums, whether it be a lifetime or for a time period certain, which we call limited paid up, the insurance company provides a death benefit, or the policy endows, meaning gives you your money back. As long as you make payments on schedule and keep to the contract, a death benefit or endowment follows the contract, and the premiums can help build up a cash value, like a savings account. And when we say savings account, we mean a conservative account that has special life insurance rules to tax deferral, compound interest, and in many states are protected from creditors, and the death benefits can also avoid probate. Now, you want to call into your team and advisor on those details, as they can vary from state to state. But just remember, life insurance money gets special benefits different than that of banks, savings and loans, and even your stocks and mutual funds. A universal life plan is sort of a blend between term and the whole life. You pay in, and the universal life plan has the ability to gain a cash value. Think of it, again, like a tax-deferred savings account. The cost of insurance is taken out of that savings account every time, and that covers the death benefit. As the account grows, the interest compounds, and there's more money to pay for death benefits or use for cash value, which we'll discuss in more detail later. UL policies seek to be more flexible and provide you with a permanent coverage, but with different ways to access your cash or use it for future coverage. They also allow you to vary how that cash grows. And a traditional universal life plan is just a fixed interest rate policy. Then you have things called index universal life policies. Those are still fixed policies, so they have no extra risk to principal compared to the previously mentioned permanent policies, but the interest earned in the cash account is derived from a formula based on an index. What these seek to do is gain cash a little bit more than just interest rate products without any risk to principal. If you read about debt instruments versus equity ones, you will see that the overwhelming consensus is that equity, over the long haul, appreciates more than debt and has a better chance of outpacing inflation. That's what these policies seek to do, and gain a greater surplus of cash value without true market risk. A variable universal life insurance is a securities product because the investor chooses a separate account of funds to which their cash value can be accrued. These funds can go up and down in value, and there is a risk to principal. Funds can be varied as much as they do in something like your 401k, and there are consistent withdrawals on the cash value for the cost of life insurance to maintain the death benefit. These operate in a risk-reward fashion, and the risk to principal is based upon investor decision. So the question we always get is, which policy is the best? Well, the best policy for death protection is the policy that is in force at the time of death. So basically I'm saying every situation is different, and you really need to review your situation every single year. But here are some basics. In general, it gets harder and harder to get life insurance as life goes on, or it gets more expensive. So people who are indecisive are basically making a decision to leave things to chance, which isn't either prudent or wise and sets them up a little bit later for some difficulties. Or people who make a temporary fix sometimes are left in a predicament later in life. Our goal in this education is to help you create a plan for yourself that just makes sense. So we're going to move into how you can figure out how much life insurance you would need, but then we're going to talk about the new things life insurance can do for you. Because we found that it makes your decision a lot easier knowing everything life insurance can do for you other than just a death benefit. How much protection you need is determined by your situation. And like I said before, you should review that every year with a trusted advisor. Basically, an advisor should help you take into account all your final expenses, uncovered medical bills, funeral and estate settling costs, outstanding debts, mortgage balances, college costs. Those are just to name a few. Then they will come up with a number of how much future income is needed to sustain the household based upon your goals and beliefs. This is the number you'll arrive to after calculating the present value of cash flow streams your family will need after your death. A word of caution for a family, especially one that has a primary breadwinner. The group insurance you might get from work is rarely enough to significantly replace your income for anything other than a short period of time. Plus, more often than not, it's not portable, meaning you can't take it with you. If you or someone you know is counting on that to protect a whole family, please call and make a true evaluation. This is all math and science here, and the numbers add up the way they add up. And nothing changes that. So at a minimum, you need to educate yourself on what you could need. Even if you do nothing with the information and choose to take all the risk, at least you know what the consequences are ahead of time. I've been talking about the foundation of life insurance, which is death benefit protection. Now, the new forms do so much more than protect us if we die too soon. We have so many other life events that we need to make sure don't rob us of our financial freedom. Life insurance has actually evolved to take care of this. Let me introduce to you our expert on additional life insurance benefits, Eric Estrada, also known as the Tax-Free Ninja. Eric is going to fill us in on the benefits of life insurance and how you don't have to die in order to use them.
Thanks, Michael. The death benefit protection of life insurance is important for sure. There's a greater than 1 in 6 chance for males and a 1 in 9 chance for females of not surviving until retirement age. But what the new type of life insurance can do is protect you while you are living. How is that, you might ask? Well, let's look at what you need protecting from. Of all Americans 65 or older, half of the women and 1/3 of the men can expect to spend at least 2 years in a nursing home. The average annual nursing home cost is $123,000. Today, life insurance can provide living benefits to help with the expenses of a long-term illness, and it doesn't have the complicated ways of helping you get the cash that some traditional critical or long-term care coverages have. Now listen, those coverage plans are great, and if you can afford to have a separate plan for each thing that may go wrong, that's the best form of protection. But many, and I mean most when I say many, people are understandably indecisive about what plans to buy because they aren't sure what the future holds, so they don't want to quote-unquote waste money. Well, like Colin Powell said, indecision has cost the American government, American businesses, and the American people billions of dollars more than the wrong decision. And not planning is still a plan. The new form of life insurance is a way to take care of that indecision. If you have any family history of heart attack, stroke, or cancer, and you don't have a standalone policy, then you need to set up a time to review your situation. Often, we find you can trade in some of your old coverage for new coverage that includes these very things we talked about. Now, if you're sitting there and saying to yourself, I'm not worried about dying too soon, and I'm not worried about getting sick, well then congratulations, you're the grand prize winner on the call. When we speak in front of a group, we always say that everyone in the room is looking at someone else and saying to themselves, I am not going to be that one that dies too soon or gets sick. It must be someone else in the room. Now, on a call like this, obviously you don't do that. But if you're like most people, it's human nature to think it'll happen to someone else. All I can tell you is that nobody is immune to statistics, and we all share the same chance. Family history gives us some clues, but ultimately, the absence of family history still leaves us with the same chance as our neighbor. But if you sincerely believe those things will happen to someone else, congratulations, because now you're probably going to fall into the trap of living too long. That's right, living too long has its own set of problems. In fact, we know that longevity is the greatest risk of all because it is a risk multiplier. The longer you live, the greater chance you have of having one of the critical life events. But even without that, the number one fear of retirees is outliving their money. More than 50% of working adults ages 50 to 64 said they may have to delay their retirement, while another 16% said they never expect to stop working. Well, what if you could defer taxes as your accumulated cash value grows and potentially access that cash value using income tax-free policy loans and withdrawals to use for retirement income or any other needs? Remember those cash values Michael talked about earlier? Well, some life policies have that available, and you can use special provisions in the life policy to access that money tax-free. It works sort of like a Roth IRA in that you put your after-tax dollars in, they grow tax-deferred, and then you have specialized access to the money tax-free. So let me ask you, in the future, and we're talking long-term future, do you feel taxes will be higher or lower? Well, this graph shows you some back history. Just FYI, look at that spike in 1932. That was caused by the Revenue Act of 1932, in which Hoover tried to stimulate the economy and get us out of the Great Depression by spending. He inherited a budget surplus when he got into office, and by 1932, when he lost his bid for re-election, the deficit had breached $2.7 billion, the third largest budget deficit America had ever experienced. Hoover increased government spending from $3.1 billion to $4.7 billion in a failed effort to stimulate the economy. And he increased marginal tax rates to 63%. Then came World War II, and you see that rate going up. Now, just to give you an idea about today's times, the Emergency Economic Stabilization Act of 2008 authorized $700 billion to bail out the banks. I'll let you make up your own mind whether you think taxes are going to go up or down. But I will tell you, using life insurance to grow cash value, you don't have to worry about how high taxes go in the future. But you need to ask yourself this. If you were a farmer, would you rather pay tax on the seed or the harvest? If you think future tax rates will be higher, then you may want to consider a tax-free retirement strategy using financial products such as a Roth IRA or permanent life insurance. And with the new type of life insurance, you can create an income stream that protects you against living too long and outliving your retirement savings. Morgan, let me turn it back over to you for some final thoughts.
Michael and Eric, thank you so much for that background and education. My closing thoughts are this. If you don't have an income plan, or you aren't 100% sure that your income plan will help you accomplish your retirement goals, then you need to set up a time to review your situation. With income planning, you cannot put off until tomorrow what you should take care of today. And we see entirely too many cases where that exact thing has happened. I know we're running out of time today for this, but this type of cash value you can use to assist in college planning. So if you or someone you know has kids or grandkids that they want to go to college, you owe it to yourself really to learn about additional college savings options. Our team has gone through the life insurance basics, how life insurance is the best vehicle to create an estate in the event that you die too soon, how the new versions of life insurance can help protect your family if you get sick, and how there are now options to use life insurance to guarantee income for life if you live too long. Our philosophy is life changes, protect it. And maybe if you haven't addressed all of these concerns separately, or if you think that you are only in a position to protect yourself against some of these concerns, you should review your situation. You are on this call because you wanted some education. But to properly act in your own best interest, you need to review your individual situation with a trained professional and help make your own plan that makes sense for you and your family. And with that, I'll pass it back over to your advisor who cared enough to spend their time and energy getting you on this call. And I'll close our educational segment by reminding everyone that an ounce of prevention is worth a pound of cure. So now is the time to make sure you have done everything prudent. Life changes, protect it.